Welcome to This Explainer. Today, we're unpacking the invisible barriers that totally dictate market movements, and more importantly, how you can actually use them to your advantage.
So tell me if this sounds familiar. You place a buy order at what looks like the absolutely perfect level. You're feeling good about it, right? But then you just watch the price flush you out, hit your stop loss, and then literally immediately reverse right back into profit. It's easily one of the most maddening, frustrating experiences in trading. But hey, I promise you, you are definitely not alone on this one.
Okay, let's dive into this and fix that exact problem today. We're going to cover the invisible market barriers, the psychology behind the zones, why you've got to draw zones instead of lines, how to navigate the stop-loss trap, and finally, trading breakouts and reversals. All right, Section 1, the invisible market barriers, floors and ceilings. Let's get into it. Let's set the foundation by defining what these structural barriers actually look like in the real world. At the most fundamental level, support is essentially a floor, where demand steps in to stop a downtrend. It's that price level where buyers look at the asset, say, yep, that's a bargain, and step in to keep it from falling any further. On the flip side, we have resistance, which is your ceiling. This is where supply completely overwhelms demand, dead stopping an uptrend because sellers step up and take control. Take a look at how the price drops down into this highlighted area. Now, instead of falling straight through into the abyss, it hits this floor where buyers just eagerly step in. The demand right here is so incredibly strong that it completely absorbs all that selling pressure. It acts almost like a giant trampoline, bouncing the price right back up. And conversely, watch how resistance acts as a really firm ceiling right up here. You can literally see the bullish momentum pushing the price higher, but the second it hits that shaded box, the rally just totally runs out of gas. Selling pressure builds up massively, forcing the whole upward move to stall out and eventually reverse.
Moving on to Section 2, the psychology behind the zones. Emotion on a chart.
Now, we absolutely have to remember that these aren't just arbitrary algorithms firing off. These are active battlegrounds of human emotion. These barriers form strictly because of the conflicting behavior of three very specific groups in the market. First, you've got traders who are long, waiting and hoping for a rise. Second, you have traders who are short, actively hoping the price falls off a cliff. And third, you have those undecided, nervous participants just sitting on the sidelines, waiting for a safe place to jump in. When the price approaches a known level, all three of these groups spring into action. It's their collective emotions that actually create that bounce or rejection. And you know what? Our own brains actually get in the way here too. Traders heavily rely on a cognitive shortcut called anchoring. This basically means that round symbolic numbers, think $1,000 or $25,000, often become these self-fulfilling barriers purely based on human psychology. They don't represent some magical change in a company's fundamentals. They're just a mental hurdle where traders automatically adjust their behavior. Pretty wild, right? Let's jump to Section 3, drawing zones, not lines, the realities of the market. So the really crucial point here is how we take all this messy human psychology and actually map it correctly on our screens. If you want to stop missing trades, you have got to burn this quote into your brain. Support and resistance are an area on the chart. It is not a line on a chart. Seriously, you absolutely have to abandon the idea of drawing a single razor-thin line. The market is dynamic, it's volatile. You need to start drawing rectangular zones to capture the true reality of where buyers and sellers are actually hanging out. Drawing these zones protects you from two of the market's absolute favorite tricks: the undershoot and the overshoot. An undershoot is when the price misses your exact perfect little drawn line by just a fraction and then reverses completely without you, leaving you stranded on the platform. An overshoot, on the other hand, is when the price momentarily, and usually violently, spikes past your level, makes you panic sweat, and then reverses right back in the direction you predicted all along. Using zones effectively absorbs these volatile spikes and near misses. Now, this leads into a really fascinating and honestly somewhat surprising debate in the trading community about the number of times a zone gets tested. Traditional analysis, the stuff you'd find in old-school textbook articles, says a level gets stronger the more it's touched because, well, it becomes more obvious to everyone. But modern price action experts argue the exact opposite. They point out that a zone only exists because there are large institutional orders waiting there. So every single time the price touches that zone, more of those orders get filled. Eventually, the orders just run out, meaning multiple touches can actually deplete the barrier, making it significantly weaker and primed to finally break. All right, Section 4. The stop-loss trap, surviving the flush.
So if we know these levels can overshoot and get depleted over time, how does the reality of these zones dictate where we hide our protective orders? Well, if you place your stop loss exactly below a single support line, just like the old textbooks tell you to do, you become extremely easy prey for a stop hunt. Notice how the market just dips its toe past the line, triggers all those resting stop losses from retail traders, scoops up all that juicy liquidity, and then immediately rockets higher. Because those overshoots happen constantly, you must give your trades a generous buffer. Seriously, never put your stop loss right at the absolute high or the absolute low of a move. Pull it back a bit. Give it some real breathing room entirely outside of your drawn rectangular zones, so you don't get shaken out unnecessarily on some random volatile spike.
And finally, Section 5, trading breakouts and reversals, putting it into action.
Let's bring this all together and see how it builds into actionable evidence-backed trading strategies. When you're in a defined trend, use these zones as your ultimate roadmap. In a bullish trend, you want to execute buy orders when the price dips down into your support zone and then use the next resistance ceiling as your target. In a bearish trend, sell when the price rallies up into resistance and target the next support floor. And here is a golden rule to remember. When a ceiling is finally smashed through with heavy momentum, the whole market psychology shifts. That broken resistance level very often flips to become your brand new support floor. And hey, this isn't just abstract theory either. Academic research investigating the JSE and DAX markets actually backs this up. The study found that combining support and resistance breakout strategies with smart, buffered stop losses actually yield superior returns compared to just traditional buy and hold investing. Basically, setting your entry point slightly above a support level to confirm a reversal and then selling near resistance mathematically enhances the overall value of a portfolio. So, I'm going to leave you with this final thought for the next time you open up your charts. Are you reacting to the genuine ebb and flow of supply and demand, drawing zones that respect actual market volatility? Or are you just drawing imaginary razor-thin lines based on your own hopes and psychological anchors? It's literally the difference between getting flushed out and staying in a winning trade. Thanks so much for joining me for this explainer, and I will see you next time.